If you own too many funds, you are actually hurting your portfolio. Large caps, mid caps, small caps, flexi caps, multi caps, thematics, sectoral funds. Each category has 15 to 30 different funds. More choice does not help. It
Struggling
confuses
with managing.
investors. It's like opening a restaurant menu with 30 pages. Here's the truth. Most investors don't need every equity fund category. A few well-chosen funds with clear roles are more than enough. Large caps for stability, flexi caps for balance, mid and small caps with limited exposure but with a lot of patience. Sectoral and thematic funds, they are high risk
Every
and
trade
wrong
eats it.
timing can
Volatility
destroy your
spikes
portfolio
multiply it.
returns. The problem isn't lack of options. The problem is over diversification. More funds don't mean less risk. It often means poorer decisions. Choose
Ensures
less,
higher
but
recovery
choose
rates.
wisely. So how many mutual funds are actually enough for investors? There is no perfect number, but there is a sensible range. And that is far lower than most investors think. For most investors, 3 to 5 mutual funds are more than enough to build a solid, diversified portfolio. Not 10, not 15, definitely not one from every single category. Think in roles, not in label. One for stability, one for flexibility, one for growth, and maybe one satellite exposure if your risk appetite allows. And that's it. Adding more funds does not reduce risk. It often just creates overlap, confusion, and poor rebalancing decisions. Before adding your next fund, ask this question: what role does this fund play in my portfolio? You may be owning 10 to 12 different funds, but in reality only 3 to 4 may be doing any real work. Many portfolios look diversified. In reality, multiple funds are holding the same underlying stocks, and that's overlap. Here is a simple way to spot it. If two or more of your funds rise together, fall together, or recover together, then chances are they're doing the same job. Overlap does not reduce risk. It gives a false sense of diversification and makes rebalancing harder. More funds is not equal to better protection. Each fund in your portfolio should have a clear and distinct role. If you cannot explain that role in one sentence, then you probably do not need that fund. Review your funds today, cut overlap, keep clarity. When should you exit a mutual fund? Most investors exit mutual funds for all the wrong reasons. They exit after short-term underperformance. They exit because a new fund is trending. They exit because markets feel uncomfortable. But none of these reasons are good reasons. Consider exiting a mutual fund only if 1. The fund's role has changed in your portfolio. 2. Your asset allocation needs rebalancing. 3. The fund has consistently deviated from its mandate. Or 4, your financial goal itself has changed. Do not exit a fund because its returns have lagged for a year or two. Good funds go through bad phases, and that's just normal. Exit decisions should be process driven and not emotion driven. Before exiting a fund, ask, has the reason I bought this fund changed? How often should you review your portfolio? Checking your financial portfolio regularly or too often can actually hurt. Many investors track the markets daily, review portfolios weekly. Investing does not need that much activity. For most long-term investors, one good review every 6 to 12 months is more than enough. Not every market moves deserves a portfolio change. During the review, focus on asset allocation, goal alignment, overlap and concentration, rebalancing need, not the short-term return. Good investing feels boring. Constant tinkering usually does more harm than good. Review your portfolio with intent and not with anxiety. And send this to someone who checks their portfolio every single day.